Fantastic. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless. Any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Yay! All right, we are good to go, I think. Let's see what's going on here. Okay, that seems to be working. You're talking too fast. How dare you? I slow down for the presentation, but that was a disclaimer. I'll talk as fast as I damn well please for that. Let's see. And you can read it on your own. If you can go to philstockworld.com/disclosure, you can read it as slowly as you want. Now, back to serious stuff. Futures, hourly chart, we have monthly chart. Oh my God, look at them go. The market is such a joke, but I mean, when you know, we have money in it, so that's fine. It's just so ridiculous. As I was saying today, it's just, you know, the rich are getting richer and richer and richer, and it's got to come from somewhere. And if it's not coming from economic growth, it's coming from the poor, so they must be getting poorer and poorer. But the VIX came way down. Nobody's worried. Let's do dailies, and we'll take a look. The VIX came down from 22 back to 16. Which is where we were cruising all through the summer, where we weren't worried about anything. So we're getting back to like not worried at all levels. And how did the indexes do in July and August? They were at their highs, right? So if the VIX is down here at the lows, then you can assume the indexes are going to drift back to their highs. So we've still got a bit to go on all these indexes. And if you want to go long, the Russell will be the one to go long on. It's got the furthest to jump at the moment. Even the Euro stocks and the DAX are all coming back. Everybody's coming back. Everything's great because people think we're going to work out the China thing. I mean, the China thing really killed us, and now we're going to work out China so we can go back to the highs and not worry about anything else, I guess. I don't think people even care about Brexit anymore. I mean, it's just this thing that just never goes away. It's been 2 years, so nobody's worried about that. People assume we're going to make a trade deal with China. Iran just came off the table, and realistically, that is a good catalyst. I mean, you know, getting rid of Bolton, he's the hawk on Iran. So, you know, getting rid of him means that tension is taken away somewhat. You know, Iran is still Iran. They're still a pain in the butt. They still sponsor terrorism and so on and so forth. But you know, there's no sense in going to war with them. We have ideological differences. People want to, you know. Obviously, terrorism is bad, but in the reality of the world, we are huge and gigantic. We are the Empire in Star Wars, and you don't defeat the Empire by sending your scout ships directly to attack them, even though it did work for Luke Skywalker. But you know, you don't send your little teeny ships to attack them. You commit acts of terrorism. That's what the rebels do. The rebels in Star Wars are terrorists. It just depends who's writing the book. Okay, the rebels are attacking small outposts and annoying the Empire and blowing things up and blowing up their Death Star, for example. You know, they didn't blow up the Empire, they blew up a ship. It didn't defeat the Empire, it just blew up a big ship they had. That's as if, you know, that's as if terrorists blew up one of our battleships in the Pacific and then claim that they defeated America. It's like, you didn't defeat America, you blew up one of our ships. We'll build another one, which is exactly what the Empire did in the next movie. And then the rebels blew that one up. None of that changes anything. The geopolitics of the Empire didn't change. So, although I did read this great economic paper that said that like it would bankrupt the empire because of the if you calculate how much money it would cost to build a Death Star, it was like effectively like trillions of dollars all put into like one weapon, and then they blew it up. So that would plunge the empire into debt that couldn't be repaid. So it was an economic blow to the empire. But anyway, so the bottom line is, so Iran funds terrorists. Now they don't fund terrorists that are blowing up buildings like 9/11 or whatever. They're funding terrorists that attack military bases and do such and such. And obviously, yeah, they could theoretically fund someone who does something horrible and so on and so forth. But it's just like the people who support Hezbollah or something like that, or the people who used to support Arafat. They're terrorists technically. The IRA, people supported the IRA. They're terrorists. You can't go to war with everybody who supports people who have ideological differences with you. The IRA used to blow up things in London all the time, and people supported them all over the place. Americans supported them. You don't even go to war with America. It's just, everything is very blown out of proportion in the world. But this is what happens when you're a gigantic empire like we are, and there's no way to fight you conventionally, then you're going to get attacked unconventionally, and unconventional attacks are technically terrorism. So anyway, what was my point? My point was that Bolton was an Iran hawk, and of course the line of logic, which is a very enticing and reasonable sounding line of logic, is to say, because I could just as easily take the other side of the argument and say that Iran does fund terrorism. Iran does a lot of things that are not nice, and they are a constant thorn on the side. They're also dangerous because they're a country that doesn't agree with us, doesn't like Israel, and they're capable of launching nuclear weapons. And therefore, something has to be done before something catastrophic happens. And you may or may not be proven right with that argument, but is that what we do? Do we attack people based on what we think? Because again, we're the empire. We don't like what they think, we don't like what they do, therefore we attack them. You will never have peace that way. If that's your answer to people you don't agree with politically and philosophically, if that's the way you have to treat everything as an attack, then you're basically going to spur more terrorism, right? Because that means anybody who has a beef against you better shut their mouth and attack you quietly. That's what you're saying. So anyway, so Bolton is a huge Iran hawk, and he's on the side of like, let's stop them before they stop us kind of thing. And that of course is why oil is collapsing. Also very strong dollar today, because England is not England. The EU is, the ECB is easing, and so we're relatively, here's the euro, so the ECB is easing, so therefore the dollar gets stronger, and we're just back to where we are. And this is our normal range. 98 is our normal number. So above 98 is a bit high, and below 98 is a bit low. But this is really our range, is right about 98 right now. We're not likely to get to 100. We're not likely to fall below 96. Certainly not 95. And so anyway, so the big dollar move up here from 97.90 to 98.20 is about 30 points, so about 0.3%. But oil went crashing down. It wasn't just the dollar, it was also the Bolton thing and some other stuff. And the bottom line is there's just so much, there's such a huge surplus of oil right now. So we'll see what happens. We'll see 55 holds up, 60 should hold on Brent. The Aramco thing is moving forward. Aramco just named 9 bankers to do their IPO, and so a worldwide IPO. It's such a big IPO, they're spreading it across several exchanges, so only parts of the stock are being released in the US, parts are going to be released in Europe, parts will be released in Asia, so everybody will be able to buy their bits on their local exchanges. It's just huge. And the Saudis, for their part, they're not getting the valuation they want, and that's going to hurt. But they know that if oil falls below 60, this thing's going to be a complete bust. So oil will hold 60, Brent oil will hold 60, which means our oil should hold 55, which means anytime you get down to this level, it's almost like a free call, because it's incredibly likely that $60 is going to be defended. So if you look on the daily, and by the way, $60 is being defended here, but look what happened. Okay, see how that $60 line is like a line in the sand? It did bust 60. That was when the whole market and everything sold off like crazy. We failed 60 and went down to 50. And that's really painful if you're long. So you do have to be careful about that. If it's below 60, just get out and wait for it to come back over 60. But look how well 60 usually holds. Usually, if you play 60, you're going to be good for $5. And $5 is $5,000 on the futures. So, you know, just keep a tight stop. Don't play below 60 unless you have, you know, mega margin and you don't care about, you know, these paper losses of, in this case, it's $10,000 per contract. So unless you can shake off like $10,000 loss and wait it out or double down or whatever, that's even pushing it for me, frankly. I don't like to lose $10,000 per contract. That's kind of annoying. But you know, you have an excellent chance of every time it hits 60 of at least making 250, 2,500 per contract. You often can make 5,000 per contract, and one of these days you'll probably get lucky and get a spike to 70 or 75. Probably not this winter, but in the summertime, yeah. So you know, good play here. We have a big play on OIH as a bullish play on the oil services. I figure they've been underinvested. A well's life is about 3 years, an oil well. It depletes after 3 years. You'll lose over 50% of the well's capacity. When it's below 50%, there's less pressure, and then you have to start doing other things to get the oil out of the ground, more pumping and such to get it out of the ground, other than it just like, you know, when you first drill an oil well, it just flies out of the ground. You've seen pictures of that, like you strike oil, the oil is already under pressure and flies out of the ground. It does that for like the first half, but once it depletes after about 3 years, it stops coming out on its own, and then you have to start serious pumping operations to get the rest of the well out. And once it gets below 20%, you pretty much give up on it. It's not even worth doing anymore. So oil services companies are the ones that they sell the drilling equipment, the pumping equipment, everything else in between. There's been a couple of years now of very strong underinvestment in oil services, and in theory, all these wells are starting to run dry, so the oil companies have no choice but to either bring in more equipment to push the wells or go out and explore for more wells. Either way, though, they should be business for OIH. So I like playing OIH more as a bullish play for oil over the long term, especially from these levels. I think it's a really good way to play oil long rather than mess around with oil in the winter when there's no particular catalyst. What's Trump talking about now? Oh, he's talking about John Bolton's ouster. Okay. So that is that. Let's see. Okay. What else is happening? That's not it. That's it. All right. So oil is oil. Gasoline low. You know, there's not. We just passed this holiday, right? So the next holiday is Columbus Day. Who cares? I'll be in California though. So I'm actually going to be traveling Columbus Day weekend, but not many people do. That week I'll be in California, and then we've got Thanksgiving. So Thanksgiving and Christmas could be a catalyst for oil, but it sure as hell didn't work out that way last year. Keep that in mind. Okay, last year Thanksgiving and Christmas were a disaster. So given that, that means it's not that safe to bid on it this year. So, you know, again, the Aramco thing makes me think they're going to put a floor at 55. Last year we failed 55 and went down to, you know, 45. So, but I would go long at 55 and just keep a very tight stop below if you can play the futures, and you might get lucky, but don't risk getting unlucky. Don't play below 55. And again, the real key though is Brent 60. It's if Brent fails 60, get the frick out, and then see how they have had trouble all month holding it. You know, and you can see the same line though, same as the 55 action here, except Brent was actually pretty damn weak here. All right, so they're going to do whatever they can to get things back up, though. Gasoline, same thing. Who knows what the demand is? And I got to tell you, these electric cars coming on the market, you're going to see gasoline go down Oil is going to go down. The only reason that I even think bullish on this is the Aramco is a pump job. It's a fake job to prop it up. Don't forget the Saudis have taken voluntarily their own 2 million barrels. That's 2 million out of 12 million that they usually pump. So they've taken 15% of their production offline. That's a lot of money they're eating. 2 million barrels, obviously 2 million barrels times, let's say $50 a barrel to make it simple, is 100 million a day. 100 million a day, that's 3 billion a month. And that's $36 billion a year that they are foregoing in order to help keep prices up, plus other OPEC nations have taken capacity offline. Russia is chipping in and taking capacity offline. So, you know, this is extremely artificial. All these numbers in oil are extremely artificial, which is why it's idiotic to invest in Aramco. They're asking for top dollar, and their assumption is that all this oil is going to just keep getting pumped out forever. And it's not going to stop, and electric cars aren't going to take over, and people aren't going to have more efficient vehicles, and we're not going to use less energy, and we're going to keep polluting the atmosphere until the world melts. It just makes no sense. It's not logical. So I wouldn't, it's not something I really am in favor of. And also the long-term picture for oil is still very dire, which is something I've been saying since oil was 100. So now it's half that price, and I'm still saying it. You know, it's really going to settle down eventually to be the price of an industrial material. It will not be used as much in transportation. I mean 20, 30 years from now, but I mean, it will not be used very much in transportation. It will not be used very much for anything other than chemical processes. And it'll be a lot cheaper, you know, which means the chemical companies are a good investment because their input cost is oil and natural gas, and then they make chemicals from it. So as it gets cheaper, somebody like Dow is going to be actually a good buy down the road. And Exxon, of course, defensively has a huge chemical division, you know, which is smart, but it's not going to save the whole company. All these energy companies 20 years ago should have gone super heavy into renewables, and they would have been fine. But instead, they spent tons of money just lobbying against renewables, and they're in big trouble now. That's why we have no oil companies in our portfolio, actually. Speaking of portfolios, oops, not logged in. Let's see what's going on. All right, long-term portfolio, 230% sounds good. 1.6, holy crap, that is good. Let's see, Control F LTP. Where was that LTP? Got to find the bottom of it. Wow. Now, I've adjusted the other portfolios. I put in the trades for the other portfolios. I have not for the long-term portfolios because just so many. I haven't had a day to sit there and do it. I need a whole day on the weekend just to update all the positions. But, so in other words, the same exact positions that were in the long-term portfolio with no changes on whatever date this was. It was, you know, around expiration day, around the 19th of August, maybe the 16th of August, something like that, when we did the review. 1.227. And now, this is stunning. Now we're at 165. We're up $400,000 on these exact positions. That's 33% in a month. That is crazy. But you know, that's wow, that is crazy. But and by the way, it's going to be way higher than that because what did we do last month? Oh shit, it's way up here. Okay. So what did we do last month? We were 1.227. We were down, now notice we were down 300,000. Don't be so impressed that we're up 400,000. We're just back to where we were. The market's back to where it was. We're back to where we were. But what I'm saying though is that this is untouched. And what we actually did is short puts. We killed all the short puts. Okay, so we did, because I didn't want to have the risk of having the short puts. So we're not going to make that money. But what we did is we added a lot, like on BNS, we rolled down, on ATM we rolled down, and we actually doubled down when we rolled down on ATM. You know, and these are a lot of September. Okay, yeah, a lot of these are a lot of these value stocks that we had. You know, because we have a lot of value. See, ALB back here was down here, and we rolled down. And these are what I call reflexive plays, right? Like, in other words, if we have a value stock and it goes against us and we don't feel the value has changed, we just take advantage of the simplest thing in the world. We take our positive calls, which were 65 calls at the time to 980, and we spend, if it's $5 to roll down $10, we'll do that. Because what are we doing? We're buying $10 in position. We went from the 65s to the 55s. Because we thought that this was silly. We thought 60 was silly. So we took advantage of it and rolled down to the 55s. Now the gain is going to be spectacular, go up here. And like I said, it's a reflexive thing. It's whenever you have a position, if you're not going to cut the position, you should be adding money to it. You should be improving the position. You don't just leave it alone. And that's why in our portfolios we always keep about half cash, because I always want to have the money to double down. I mean half cash, like, in other words, if we have half cash and things change and we end up in 3/4 and we end up in 1/4 cash, then I want to cut positions to get back to half cash, because every position in my portfolio I want to be able to double down if I have to. So if it's a let's say we have a 9/11 thing, the market drops 20% next week. Let's say something blows up, somebody nukes a city somewhere. This could happen at any time, okay? If that happens, the market's gonna open down 10%, 20%, who knows what? It could be closed for a week and then open up down 20%. We don't know what's gonna happen. We didn't know what was gonna happen in 9/11, it was a disaster. You couldn't trade. You just said you couldn't trade, and nobody wants anything. And then markets open Monday, and all people were doing was selling. Everybody sell. When it finally did open, because everybody's like, "Oh my God, the world's a disaster." You know, and of course, if you're smart, you're buying at that time. It's panicking. You have to analyze. Now, it's different if it's let's say New York City got nuked. That would be very different, because New York City is not coming back from a nuclear attack. You'd have to look at the economic impact of what happened, plus also the entire landscape of the changing world going forward. You'd have to call all that stuff into question after something horrific like that, which is again why you always have hedges, because if you don't, you can get totally blown out of the water by something like that. So that's different. But in 9/11, what happened? They knocked down a building. Okay, yeah, that's catastrophic. It's horrible. 20 years later, we're still freaking out about it. But the reality is, it's a building. We can fix the building. We rebuild the building. We rebuilt the building, right? I remember the apartments. There's a thing across from the World Trade Center. There's a condo. It's called Battery Park City. And those condos were $600,000–700,000 before 9/11. They went down to under 200,000 after 9/11. And what a horrible place to be. I mean, you're there. You had dust from the Trade Center, dust meaning dead bodies and whatever was all mixed up in the rubble. The whole building collapsed, all the people inside it were dead, and there was just, it was horrible. Anyway, so that's, and if you lived there across from the World Trade Center, you were basically wading through it wherever you went. People just left. They just dumped their apartments at any cost. Now, logically, buy them, right? I mean, for $200,000, because eventually they'll clean it up, and eventually people will forget. And eventually people will move back, and those things are now $1 million. So you know, huge potential real estate thing there. You know, it's cold-hearted, but you have to step back and be rational about things like that when they happen. And that goes. So you always have to evaluate, like, why are things going down? Is it a general panic, or what's happening, or whatever? And you can see that from the date. It just so happens that on expiration day we had a real low in the market. And we got great prices on a lot of things. So we did Best Buy. I don't know where Best Buy ended up. No, not Best Buy, Best Bid. Bed Bath & Beyond. I constantly do that. Oh, see, now look at that. That's so cool. All right, so Bed Bath & Beyond made a huge pop since we did that thing. Whoops, where was I? And what do? We roll 20 of the $15 puts to 40. So well, that was not a double down though. We rolled the 875s to a $9 put. So we lowered our target. Now we're in good shape. BHC, we bought back the short calls. That's another thing you do, by the way, when the short calls get cheap, and you can buy them back, because, you know, look, if a 2021 short call on a $35 stock is down to like $1.50, all you can make is 10 cents a month until they expire. So I would rather clear the decks and wait a couple of months and see if perhaps the stock goes higher and we can sell something for a better price. Right? There's no point in it. For 10 cents, all you can do is lose 10 cents. If you're wrong, all you did is miss 10 cents a month. They could have gained if you would have left them there. You know, that's not really the biggest deal. If you happen to get lucky and the stock does pop up, and we'll see if let's see if it did. BHC. Okay. Yeah, so it came up a little bit, but you know, it's not. You know, that's a lot more than 10 cents. So we're thrilled that we bought those back. We did well. Let me put this right next to it so I'm good. Oh no, that's not right next to it. That's right next to it. There we go. Nope, that wasn't even the right one. Oh, I'm such an idiot. All right, charts, that one. We'll look over here. Here's Citi, and I said, All right, so here we bought back to 77.50, not because we're gonna get there, but they were 37 cents. What's the point of having them? They're only going to pay us a couple of pennies a month while we're waiting. And meanwhile, by clearing the slot, now we can easily sell something at a better price. Cheesecake Factory, we decided we doubled down on Cheesecake Factory. Let's hope that did good. Remember, none of this is reflected. All these great moves haven't been logged yet in the portfolio. Whoa! Wow! I'm telling you, I love value stocks. I really love being a value stock player. It is so much more fun than any other kind of play because of that, because that's exciting. I love that. You know, we have this in the hedge fund too. This is fantastic. Look at that turnaround. Because this is stupid. It's like when it goes down this low, you have to make the decision. If you're going to be in a stock, be in a stock. You can't take a loss. Let's see. In other words, what do? We had the 35 calls. All right, and cake was right at the 35 line. Now, I must have looked and decided that I would rather double down than roll down. And that means really I have a lot of faith in the upside. But you know, at the time, because if I'm being defensive, I'm going to roll down, because then I'm only paying half, right? I'll pay $5 to roll down, $10, but doubling down is a lot more expensive, obviously, usually anyway. So we doubled down instead because I really thought this was a silly price. And again, there's a lot that goes into it, but what am I saying? It's Cheesecake Factory. It's a very steady restaurant business. Their value compared to Chipotle it's so ridiculous that Chipotle is 100 times earnings and Cheesecake Factory is like 10 or 12 times earnings. So somewhere in between is the right number for both of them, but certainly not 10 times earnings for Cheesecake. And in fact, see what I said? They had a nice beat, 82 versus 81. They did 2 acquisitions, which people hated, but it's only 440 million, and they're making 120 million. I put my logic down here. So I'd rather have more of them. You want to sell me for that price? I'll buy them. But don't be wishy-washy. In other words, if you're in a position, and well, let's see where it was. Cake. Here it is. Okay, so 38%. That's right around where I do tend to make my double down. So I'll make a decision usually if we're down 40%. But we bought them for 8. No, I'm sorry. That's the that's not cake. These. Okay. I'm like, what? These are the long calls. We had 25 35s. We bought them for $13. They were down to $5. So they're actually down 60%. And I was like, screw that, I'm going to double down. My target originally, we bought the 35 calls for 13. So clearly I thought it was going to go to, I don't know what the short, we bought back the short calls already, but clearly I thought it was going to go at least to 45. So I'm sitting here saying, well, this is kind of crazy because here we are with a cost, I mean, obviously we saved something from the short puts, but we got this, here's our target here. In fact, I was so short it's 45, we sold the 45 puts. So, and nothing changed. Like there's nothing bad in their report. They beat on earnings. They're all in good shape. So I'm like, there's no reason for this thing to be this low. So if you sit there and pray it comes back, that's not a good strategy. But we bought more at 475. So now our average is 13, 14, 18, about 1850. So our average is, average is 9, so our average goes to 925, which means now at 45 bucks, we certainly make money. And here we are, almost back to 45 bucks already. I'm sure we're probably about even on that. And how much of a difference is that? That's because we had, we were down $22,000. We spent $11,800 to buy more stock. That doesn't change that we're down 22,000, but now we're probably back 22,000. So we, on that one position, just making that one change, we're back 22,000 plus whatever the puts made up on the thing. But you can't sit there with a losing position and be wishy-washy about it. You're either going to cut it or you're going to do something about it. Don't do nothing. That's the important part. Don't do nothing. And don't have so many stocks that you can't afford to make moves. If you can't afford to make moves, you need to cut back. You can't say, oh, I'm not making any moves because I can't afford it. Because here we are. We turned something. Now we made a pretty full recovery. We recovered $400,000 in the portfolio. We made a full recovery of what we had lost in the downturn, plus $100,000. But that's all we made if we didn't make these changes. Making these changes is going to add another $100,000 to $200,000. And that's how you make the real money in your portfolio, is by taking advantage of these dips and doing something about it, not just crossing your fingers and hoping you get your money back. That's not a strategy. All right, so CPRI. Let's see, 30, we roll the calls, we re-roll these down. Now remember, that's defensive. If I roll the calls down, it's more defensive. CPRI, yes, it's like everything did the same thing. It's like a huge moves back up. See if you have any questions here. Nobody has any questions. Okay, good. Caesar, let's buy back 20 of the short puts. That's not a thing. Why did we do that? Caesar, because Caesar in their case, they went too high. So I said, well, to lock in the gains, I said, let's buy back, because they were way up here, and they're still way up here. But I said, to lock in these gains, why should I risk having the short puts ricochet on us? We bought back the short puts, and now we don't have any risk other than whatever the bull call spread is. I'm not going to go over every one because it's crazy. Disney, I said, I think we got lucky. So we bought back the short calls. See this dip, I said, I think we got lucky. So we bought back the short calls, which were the 130s, because I just didn't see us going back that low. So we bought them back while they were cheap, and now we're waiting for it to come back up, and we'll sell some more calls. Again, what are we doing? We're taking advantage of the channeling. We take advantage when something's low, we make a bullish move. When something's high, we make a bearish move. FCX, I'd rather double down for 155 and drop the average cost of the calls to 280, because the the roll to 5 is 280. So in other words, at this point here, I said, if we roll our, what do we have? Ford, FCX. Okay, 50, yeah. So if we rolled our 50 calls down from, and they dropped 50%, 60, they dropped 60% on us. So if we roll the $10 calls to the $5 calls, okay, it would have cost us $280. It was only $155 to double down. So I'd rather double down. And now we're back at 10, so we're probably in very good shape. And I said the 20 short puts I'm not worried about, as that's still our target. And I don't know what our target was, but apparently our target is 10 bucks. No, wait, I'm sorry, 15 bucks. So our target is 15 bucks. And again, this is a China trade thing. And we felt that eventually we get back on track with the China trade talks. Not now, but it's a 2021 trade. At some point between now and 2021, we figured we'd resolve the China issue. And in fact, even if we have to wait to the election, as soon as, once Trump is out of office, then you can start betting on China anyway, because the Democrats would fix it. So unless Trump gets reelected, the only way that this wouldn't work is if Trump gets reelected. There's really not much chance of that happening so far. GNC, we bought back the short calls. I don't know how that one worked out. GNC. Oh, way better than I thought. Look at that. Damn it. I love this stuff. And again, it's the same thing. What do we do every time? I'm looking now. Gilead on the track, GIS exploded higher, so that was a winner. GNC, gold. So notice all the value stocks that we have that we felt are good values. And Barrick Gold, we had to stop 20 of the 40 remaining January 10s, but it was over, so we cashed out. See, good call. It was 20 bucks, and I'm like, that's too much. And we talked about that last time of the webinar too. Too much is just the same as too little. You have to understand what your stocks are worth, okay? Just because Barrick Gold went to 20 doesn't mean it's worth 20. So I'm not going to sit there with 40 whatever remaining January 10s. We're way over it now. I think we should just cash all 40 out. Yeah, the January 10 calls, and we're at 20. I'm like, I'm sorry, we did not expect to be at 20. So whether it went higher or not, I don't care. That was good. And we expect to pull back in gold. We expect to pull back in Barrick, and it's all going to be good. So hopefully we'll have a chance to get back in. I'd like to see it a bit lower. If it hits 15, I'm probably going to get kind of enthusiastic about jumping back in. But if you're not going to take money off the table when a stock is double where you started, when are you going to take off? If you don't take a profit when you have a profit, what are you going to do? Only take losses? It doesn't make any sense. You've got to be able to take a profit and recognize that you made quite a lot of money and you should be done. There'll be another thing to trade. You can find something else. GoPro, blah, 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 blah. Okay, whatever. All right, go. Money, we aggressively long. I think we give another quarter. Okay. What happened to GoPro? A lot of these are basically pre-earnings. So I don't know. I wasn't really paying attention to what happened after that. It's another good thing about, very nice. It's another good thing about being a value investor is, and again, I'm a long-term value player. So to me, I don't care really what happens every single quarter. I care about the trend over a couple of years. So, these are decisions I make, and then sometimes I notice and sometimes I don't, but they have their earnings reports, and it's like, oh, very nice, that's good. But it doesn't change, unless something fundamentally happens to change the value of the stocks we're investing in. I don't care. I don't care what the price is. Price is not value. The opinion of the random idiots who buy a stock is not the value of the stock, okay? You have to look at the broader trends. I care about if the stock is worth owning. Are they going to make money? Are they going to make more money than they're going to make money that gives me a good rate of return, at least 5%, which is a 20 PE. They're not giving me a 5% rate of return, I can certainly do better. If they're giving me a 10% rate of return, a PE of 10, then I'm very excited about that, especially if I feel it's safe and steady. Because my fallback, I don't care what the price is, my fallback is that they're making 10% on their money every year. That will eventually work out for you. And that's why I like the value stocks, and we generally stay away from the momentum stocks because those have 30, 40, 50 PEs. I'm not interested in that. I don't want to bet on an uncertain future. I want to bet on uncertainty because we make ridiculous amount of money betting on. It's beyond ridiculous. This portfolio went up 33% in 1 month. Okay, and these are not risky stocks generally. They're all value stocks. They're all good multiple stocks that we liked. And look at the variety, it's really incredible too. So HBI, we bought back the short calls on HBI. Ah, lovely. Wow, everyone's a winner. Look at this. It's really crazy, huh? IBM did it. Even IBM popped. Wow. So what do we do with IBM? We bought back 10 of the short calls. Didn't want to overcommit, but we bought back 10 of the short calls to give ourselves more upside and a better position to sell short-term calls next time they hit 145. So in other words, right here is where we should be selling short calls. Also, let's buy 15 of the 130 calls, and that way we can cash the 110 calls. Oh, that's so clever. As they hit $100,000. So let's see what we have. We have, wow. Believe me, I'm as amazed reading my stuff as you guys are, because I mean, I'm just like, wow, how did I know that? So we had 25 $110 calls. So we want to see them at, wow, I'm calling 40 bucks on those. Let's see where they are. The IBM 2021 110s. IBM, I don't think they're there yet. 2021 110s. Oh, getting close, 35 bucks already. That's it, that's getting there. So let's see, 35. Where's calculator? Calculator. So 35 times 2,500, 87.5. Very nice. And what were they last time? They were 68. So you can see why we gained so much money, because these popped 20,000 bucks, just these calls. So now basically what I want to do is watch IBM and see. Oh, let's get a better picture. Want to see how they handle 145. So 2 days doesn't tell the story. They're consolidating hopefully for a move up to 150. This 150 would be the 100,000 goal that we have to cash out. But since we already bought the other ones and they've made a tremendous amount of money, I don't think I'd want to take much of a chance. So if we can't hold like 142.50, I think I might want to get out and just be very thrilled that we got that $20,000. You know, and again, there's no need to be greedy because this cycles up and down all the time. So as you know, if you just play it properly, you'll always have these kind of opportunities. IMAX, I love into the end of the year. I don't know if they've popped up too much now, but yeah, IMAX, I see not a big pop, but they're back on track. International Paper, wow, look at that. So, and again, they got knocked down as sales missed estimates, but earnings were a beat. So let's take advantage and buy back the short calls for 195. We're going to roll out 15 $40 calls to 20 of the 2021 35 calls. Beautiful. So right around here, when we were making this call, I said, let's roll the $40 calls, which were no longer in the money, down to the 35 calls, which are down here. And I said, so cash wise, so basically from a cash perspective, we went from 64.50 to 13,600, and we bought back the short calls to give ourselves room to run on the upside. Then we'll resell the short calls, blah, blah, blah. It's just a cycle. But it's a cycle because we understand the value of the company. It's a cycle because we know when it's too cheap, we know when it's too low, and otherwise we just wait. KHC, oh my God, even KHC came up a bit. Wow, they have been destroyed. And again, KHC has been a disaster, and I said, but this is very silly at 25. And 30 was silly, which is true. So this is stupid also. So we rolled out 20, 30 calls to the 20 calls, and we spent $465 on that. So we rolled out 30 calls to the 20 calls. And if you notice this, we spent less than $5 to roll from here to here. So as long as we hold 30, we make $5. We're making 100% on the new money we're putting into the position. And also because we're improving the position down the road, we now have the leverage to sell short calls and make an income back on it too. So there's two reasons we like to do that. There's other $550 in the money, be silly not to take advantage. That way, if there's a pop, we can safely sell calls. Oh, okay, see, I'm very consistent anyway. So that way, if there's a pop, we can safely sell some calls to help defer the cost of this roll. See how like logical it all is? We can also roll down the short 40 puts to the short 27.50 puts, and now we're in the money on our puts. So that worked out great too. So we are going to be banging money in this portfolio. I'll do the update this weekend, and obviously next week we got to do the reviews all over again. Oh, it never ends, does it? But you know, I mean, this thing is going to be getting close to. We're going to be on the road to $2 million on this thing. That is crazy, and I'm sorry, we got to cash it. I'm not running a $2 million portfolio. That's just it's time to get it. It's time to start fresh. LB. Well, let's see. I'd rather double down and buy 50 more 20 calls and sell 50 of the 21 and 30 calls, so and we sold the 20 puts for that. Wow, okay. It was pretty aggressive. Let's see what happened. LB. Yeah, no. Now in LB's case, it actually went lower to 16, and now we're barely back. So this is so far a loser for us on that one. Finally found a loser. Look at that. Freaking limited. Such an annoyance. Lockheed Martin, look at this, part 4. Now, this is why I want to cash out. This is ridiculous. It takes me so long to review these things. Macy's. Did Macy's actually come back? The short puts no longer seem like good targets, so we're going to roll them. Oh, no, that's a lack of faith there. Then the 10 short 25 puts to 40 of the 21 puts. So that was a defensive move. It was not an aggressive move. And ew, not really coming back. It came back a bit, but not, you know. But the point is we reset our target to the $18 puts, and now we are back at close to 18. So hopefully the whole point is that those puts expire worthless, it'll save us a fortune. MJ, not it went lower than it was. We brought back the short calls, and I said this is a gift as a new trade. I still think it's really good. We talked about it this morning. Philip Morris just got hit today because Trump, in fact, was just now talking about vaping. He is not a happy camper with the vaping. It's a little more complicated than they're making it seem, but this is where they're all over the place because of this. They have a lot of money invested in vaping and such, and it's a problem. There's nothing inherently, it's not the vaping itself. It turns out that a lot of these cartridges use vitamin E as the oil base. And when you heat the vitamin E, it becomes very damaging to your lungs. But it turns out vitamin E is very good for you, unless, of course, you heat it and turn it into a gas and breathe it in which case it's very bad for you. And that's the crux of the problem in vaping. There are other bad chemicals too. And of course, yes, the FDA does have to start regulating this stuff and saying these are good and these are bad things to put in vapes. You can't just shove anything you want into a vape cartridge. You know, but I mean, unfortunately, that's the way regulations work in this country is people can start selling things and then you find out that it's bad for people and then you start cracking down with the FDA and all that. So hopefully they don't knee-jerk just ban the whole thing because it has some technical benefits compared to smoking, but not the way it's being done, not the gung-ho cowboy way it's being put out. But and again, that's why, you know, really things like this should be legalized and regulated very quickly. And they should really go through the same, if you're consuming it, you should be going through the same FDA reviews that drugs do before you release them. You shouldn't just be flooding the market with them and using teenagers as your test market. That's very unfortunate. Mittal, oh, look at that, beautiful. So I'm excited to buy more of this one as we started small, expecting rough times. Now we rolled at 15 calls to 4, so we doubled down and rolled lower. We went from $3,800 to $17,000. We put a lot of money into this, and it turns out we did it at just the right time, and now we got a nice pop. So this will all be great if these things keep going. But meanwhile, like I said, I mean, this portfolio starts closing on $2 million. I want to just take the money and run. And it's like, okay, this is all nice, but I don't need to wish things go higher. I would rather just have the $2 million in cash and figure out what we'll do later. then start again and figure out what we do with $2 million, rather than just letting everything ride and hoping that Trump doesn't screw up or something, which is kind of unlikely. MU we took off the table. NLY, REITs are getting killed, blah, blah, blah. And they actually did. They got worse, and now they're getting a little bit better. But I think this is a little stupid. Actually, had I seen that, I would have actually bought some more. That's crazy. Dave and Busted, we just talked about, and we just rolled them and improved them, and they're all over the place, but basically around where they were when we started. Not when we started, but when we adjusted. Oh, Restoration Hardware. Yeah. I said, wow, we nailed the entry, but we only have that small position. And that's the bad thing about scaling is when you do actually hit it right on the nose, like we did with RH. I forget when we came in, but we came in like right at the bottom. So what was the bottom? So yeah, I think we came into RH. I believe we bought them like right here, like literally nailed it. And they just been nothing. Oh, no, I know it was right before earnings. We bought them before this earnings because I said, how could RH be 90? That was like so ridiculous. And again, it's a stock we used to play back in the days. It got too expensive for us, but then when it came back to, it got to the 130s, and I knew the 90. I was like 130, because at 130 we were like, okay, we're not playing this anymore. It's too much. But when it came back down to 90, I was like, oh my God, we get to buy it again. And now it's just completely exploded. So, but again, what happened to us here, and then, this is what happens when you scale in sometimes. We bought a small piece of RH, a lot less than we really wanted to have, but we didn't expect it to pop, $30 effectively on earnings. We didn't think it was going to go up 30% in one shot. So we never ended up buying more. We just have this small little position. Now, small little position is going to make us. It was a $5,000 net spread. It's going to be $50,000. We're going to make nine times profit on 900% profit on the spread. Because all we did was spend net $5,000 on this spread. That was basically a 10-bagger. So that's what we call an unfortunate one, because it got away from us before we could add more. We would have actually had a much bigger position than that. SKT, another one I saw banging the table on. Let's see if they're cheaper now, because they probably are, because it's relentless. Oh no, they popped up. So this is a REIT. This is Tangier Factory Outlets. They're a really well-run outdoor mall REIT, like factory outlets. But Tangier's isn't like you go to some factory outlet malls and they're really crappy. Tangier's has like a little park, and they have areas and commons and ice skating rings, and they make their whole thing like a lovely place for people to go. They have festivals like at Christmas. I know towns in Jersey and in New York where Christmas people go to the Tangiers because there's a big thing, and they're handing out hot chocolate, and all the vendors are having party things, and people gather around, and there's singers, and there's things going on all over the place, and it's just they turn things into an event and make it a place where people like to go and hang out, and it's more of an experience sort of thing for the towns. And again, I'm not like a big mall fan or anything like that, but really, I see this because of my kids, because they're always meeting their friends at these places, and that's where the events are going on. That's where something's happening that people want to go to. So they end up having like a 96% occupancy in their places. Also, the management of Tangiers is very cognizant of their risk, because what they do is they don't allow a lot of very big vendors. So like no tenant is more than 10% of their occupancy. So in other words, across all their places, they have no tenant. I don't even think 5%, but nobody dominates them. They don't have any giant tenants where if the guy went out of business, they'd be screwed. Everyone they have, and also they diversify, and they don't have a lot of people who compete with each other. They try to keep it like one or two of each kind of store, and it makes it so everybody prospers in their space. And it's very well done. People love it. They're constantly booked. They make constant money. I don't understand how it ever got this cheap. It's still a good value down here. And the bottom line is that that's why we were, and they're paying a huge dividend. They're paying a 35-cent dividend. per quarter. So that's like 70, 150, 140 a year against the against what was here. He was like, you know, basically at this point they're paying a 10% dividend. That's insane. But anyway, I said I'm just tired of telling people how good this thing is. I said we have 40 short puts, so we effectively intend to triple down if they stay this low. And if not, there's not much else to do but wait. It's not worth selling calls because I figure they go up too much. And as long as they keep paying us $700 a quarter, which is $2,800 a year against our $34,000 position, what do we care? I don't care if nobody likes it. I said it's a lovely place to park our cash. Okay, we have in the long-term portfolio $800,000 of cash. So why wouldn't I tie up $35,000 in Tangiers that's paying me a nice dividend? Right? You want dividends, you want to make some money. It's better, and again, better, it was what we talked about this morning, better than keeping in the bank. Rich people like us have the option of creating our own interest. You know, dividends are like an interest. So I don't have to keep my money in the bank. I can keep my money in Tangiers. I can keep my money in Ford. I can keep, well, Ford's a bad example. They went down today. Yeah, well, I'll listen to that. They got hit with a downgrade. You know, I can keep my money in IBM and they'll pay me a dividend. That's fine. I don't need the bank to pay me an interest rate. I don't need to worry about money markets. I can just leave my money in the market. And I'm not even talking about selling calls. Then I could sell calls and make more dividends. Technically, it's not a dividend, but it's like a dividend. And if you sell long-term calls, it's long-term capital gains. And Trump is, in fact, working right now in order to lower your taxes more on long-term capital gains. Although Elizabeth Warren is working to take them all back. So much as I want Elizabeth Warren to win, it's going to be painful. STT, another one I was like, I just could not believe they were that low. And I said, what the fuck on this one? Because it was just ridiculous. I could not believe this thing kept going down. And, you know, look, I mean, our thought process here is gotta be, am I giving up on this or not? If I'm not giving up on it, then I need to put money into it. All right, it's like your house, right? Your house, you have a disaster. So this is a housing disaster. Something happened, we have a flood. There's tons of damage, we lose value. Are you going to scrap it or are you going to fix it? Your position is like that. You've got to either scrap it or fix it. You can't be wishy-washy. You can't say, oh, I'm going to stay here and just smell the rotting wood. You know, and I'm going to walk on the rotted floorboards and I'm going to risk all the electrical problems and whatever. No, you fix it. You have to fix it if you intend to keep it. And it's the same thing with a stock position. Why would you not fix it? So what do we do here? All right. So I said, look, this is a huge bank that's making $2 billion a year very consistently. And here's what I'm looking at when I say that. STT. These guys are my go-to. You got to pay for it, but it's good. So I say, look, this is what I mean when I say 2 billion. Look, 2 billion, 2 billion, 2 billion, 2 billion, 2 billion, 2.5 billion, 2 billion, 2 billion, 2 billion. Okay, so very consistently making $2 billion. They are growing revenues, but they're not really, you know, not really boosting profits. Although honestly, this is, you know, averaging here 2.2 billion going forward, right? Versus 2 billion here. So over this 5-year period versus this 5-year period, they gained 5%. I'm sorry, not 5%. Sorry. 10%. They gained 10% in this 5 years versus the previous 5 years. So good. And then that means that means 5 years from now, they hopefully will be up about 3 billion. And if they're 3 billion, then the market cap should be 30 billion, certainly not 21 billion. And 21 billion for a company making 2 billion is very low. Especially for a good, solid, diversified bank. that's been around forever and is a top-notch contender in all sorts of things. They're not as famous as Goldman Sachs and whatever, but they're a very adequate contender in the space. So I don't care. It's not their fault that their stock price went down. And again, just like if you think of all the companies whose stock prices went ridiculously cheap in 2008, right? They were down in 2008 and they were still down in 2009. It didn't mean you shouldn't have bought them because the price was wrong. People were wrong about the price and the long-term value of the stocks. People aren't that smart. They react very emotionally to things that you shouldn't be reacting emotionally to. Same thing here. There's nothing to do but double down on this one. Okay, we rode our 50 calls to the 45 calls, and we bought twice as many 45. So we went from 12,800. We put another $23,000. We really tripled down on the money. We put $23,000 more into the thing, and then we rolled the short puts. That's more defensive. We rolled the short puts and retargeted. But we added quite a lot to this and they blasted higher, so that's fantastic for us. But again, it's not complicated. I'm just doing the same thing whenever I feel a certain way. If I see it and I look at it and I think the value's there, that's what we do. Wow. So target was over our target already when it was here. And now it's like, bro, ridiculous. This is crazy. And we have 100% left to gain, and all I had to do was hold 82.50. That's great. THC, no changes. We love them as a new trade. How's THC doing? Wasn't that one of my 5 trade ideas, right, from the new thing? Whoa! Wow. Okay, that's good. Damn. I'm on a roll here, aren't I? WBA, oh, again, another one. How many times have I said this about WBA? How can it be this low? This is stupid. So we brought back the short calls. And it's hard because at some point you start thinking, well, maybe these people are right, maybe I'm wrong, maybe I don't understand what I'm looking at. And obviously, it's not all about just how much money. In a bank, frankly, in a bank, it actually is. It's pretty much about how much money it is. Because that's what a bank does. All they do is make money. Walgreens makes stuff. They have stuff. They have services. So they can have problems. State Street, unless all banking is having some kind of problem with regulation or something like that, State Street's just a bank. They take money and they make more money with it. It's a very simple concept. So you're not going to get you don't have the risk factors that you have with with something like Walgreens. So in State Street, so in State Street, now of course if the economy goes down, they'll go down, whatever. But State Street is a bank, and I'm not in there. I easily double down. Walgreens, I say, you know what? There is some risk. Something could happen. A competitor can beat them. Costco and Walmart and so on. And Target can go more into the RX. They cannot lose business. CVS can do something here. Not likely. But, anything can happen. They just bought out Rite Aid, basically. So, there's not really many competitors left. I'm in Florida, and every corner, there's only one supermarket in Florida. It's called Publix. It's so hard to find. You have to go way out of your way to actually find something that isn't a Publix for a supermarket. Their strategy is to flood the market. So as much as in the north you see a 7-Eleven, like in every town there's a 7-Eleven, in every little village there's a 7-Eleven. It's just you can't, it's always a 7-Eleven, so there's hardly any other kind of convenience stores. There's Publix like that often, like just everywhere you could imagine that a supermarket would fit, they put a Publix there, just to crowd out any possibility of competition. Walgreens and CVS do that too. So pretty much everywhere you see a Publix, you also see a Walgreens and you also see a CVS, and there's just no room for anybody else. It's absolutely crazy. But nationally, they're like that. And Walgreens merged with Boots, which was the largest pharmacy in Europe. Boots is huge out there, especially England. They control England. And now they bought out Rite Aid because Rite Aid was struggling. So it's a juggernaut. And they've gone from 103 to 131. This was the They're bringing in the Rite Aid stores, and now they're going to be basically steady-ish. You know, steady-ish is still growing nicely over a couple of years, another 10, another 5, 8%, whatever it is, 8%. The numbers, though, are going to go up nicely. They're at $5 billion plus easily in earnings, and you can buy the whole thing for $51 billion, even after the boost just now. It's 10 times earnings. And we're in a demographic where the population is aging and more people go. And believe me, I'm 56 now. I can't remember how old I am. I'm 56 now. Until I'd say 10 years ago, I don't think I really, had much to do with any pharmacy. Really, other than picking up stuff for the kids, I really had no reason to go to any kind of pharmacy. Now, I got to take these pills, and my doctor says I'm low on vitamin D, and blah blah blah. And it's like all of a sudden, I'm like, I know where all the pharmacies are. So, I'm the tail end of the baby boomers. I'm basically the last year, so 1963. I'm right at the end of the baby boom generation. So, the demographics are for years to come are heavily into the pharmacy. And I remember I take a couple of things. My grandfather, I know, had like 11 different pills he would take, and I see a lot of old people. I think my mom takes a good 5 or 6 different kinds of pills. I mean, that's what you do. It's how it works. It's how our medicine works in this country. Unless they make drastic changes, that's not going to change. And these pharmacies, it's not about the pricing, because they don't make a lot of money handling the prescriptions. They're not marking it up particularly. They're getting a little fee for handling the prescriptions and dispensing. But they're not the ones jacking up the prices. They don't buy, they don't get the pills for $100 and sell them for $200 or anything like that. So people act like the changes in the system are going to hurt the pharmacies. They're not going to hurt the pharmacies. Somebody still needs to dispense the pills. If you go to Cuba, they still have pharmacies. They don't not have pharmacies. Everything's free, but they don't still have to have a pharmacy dispensing it. The pharmacy still charges a dispensing fee, not to the consumer, but to the state. So, these businesses are not in that much danger, and they branch out. I mean, you go to Walgreens and you're walking through a whole supermarket basically before you get to the pharmacy, which is way in the back. In fact, they force you. They always do that. The door's in the corner and the pharmacy is in the other corner. So you have to weave through all the stuff in order to get to the pharmacy. And my kids go there to get their beauty supplies and things like that. And they have a lot of basic food now. Now they have milk and things like that. So down here, they don't have as many 7-Elevens in this part of Florida anyway. And so, if I run out of milk, I go to Walgreens. If I need something basic, I'll go to Walgreens for some food rather than try to find a supermarket that's open late at night. Anyway, so they have a nice diverse base. In fact, let's take a look to see if we can figure this out. Sometimes in Thinkorswim, for big companies, they'll have a profile. Oh, I wag. WBA. See, if you see this company profile, these are cute. I like these. So see, retail pharmacy is 59% of their business still. Retail pharmacy, OTC, wow. What? Now this is mixed up. Retail prescriptions filled in the U.S. They fill 16% of the 20% of the. Look at that. They went from 16% to 20% of the prescriptions filled in the U.S. Doesn't tell you the time frame. There's 5 billion prescriptions filled annually, and the revenues of the retail. So everything's projecting up and up, and everything's growing because you can't help the demographics. This is confusing though, because it doesn't. It's mixing up retail, all their retail with the pharmacy stuff. So I'm not sure if there's a way to, and this one says over the counter, number of drugstores, see how they're steadying out after some big growth, they steadied out. Square footage per store has increased, so they're getting bigger stores. Front end revenue per square foot, this is really important. So the front end revenue per square foot, 308 to 319. That's fantastic. They're increasing their footprint and increasing their revenues. Anyway, there's lots of stuff you can look at like that when you have these company profiles. So they're nice. Point being though, it's a big, diverse business. They sell lots of stuff. It's not just about the drugs. They don't get killed as drug prices come down or the government takes over more. That's really the fear. And if it wasn't for that, they sure as hell wouldn't be trading 10 times earnings in the first place. So this is a very good, big, solid company. And I love them. And I couldn't believe how low they were. So what did we say? We said we bought back the short calls and we wait for the next pop. And now we're popping back up. We get to 65, we'll probably sell again. And Whirlpool, we bought back the short puts. And if Whirlpool went up, that means we only had one incorrect play. Yes! We only had one incorrect play in all of our changes to the long-term portfolio. This thing is going to be on fire. And not that $400,000 in a month is not on fire, but it's going to be more on fire than that. Look at the options opportunity portfolio. $330,000, same kind of stuff, right? Same, I'm not going to do it all again. The same stuff, we have all these value plays in the long-term portfolio. We pressed all our value plays that we felt like pressing, all right? And it was 178,000 there, and I know it's well over that now. I'm sorry, what is the options opportunity portfolio? Geez, 300%. Wait. Something's wrong. Was this not the options? Oh, this was a butterfly. I'm like, that can't possibly be right. There's the total, 330. Still, we went from 330 to $400,000 in a month. So $70,000 gain, 20% something gain in the options opportunity portfolio. And by the way, the difference is that the options opportunity portfolio has the hedges in it. So the hedges lost money and the longs gained money. The short-term the long-term portfolio is all bullish. So it gets a tremendous gain in the market gain. And all the losses taken in the short-term portfolio, which did not actually lose all that much money. So we came out very, very well in this case. But the options opportunity portfolio gained a much more sensible 20% because it also has the hedges, so it lost some money on the hedges. And by the way, the adjustments are in I think every portfolio has all the adjustments but the long-term portfolio, which I didn't get to yet. So the butterfly portfolio, which was at 178, is now at, no, really? I always keep checking because it's crazy. Butterfly portfolio, 178, and I think we only made one adjustment. OIH, we got more bullish. What do we do with OIH? I was just saying how I think they should be good. It's another disaster ETF, but rules are rules. And again, this is very important, okay? You're not being a value investor if you just buy something and cross your fingers. There are rules to what we do. So it went lower, we're not going to cut it, and if we're not going to cut it, we're damn well going to improve it. So we rolled out 2021 15 calls to the 2021 $10 calls, and we went from 55 cents to 155. No, I'm sorry, to 210 for net 155. So we tripled down basically on this thing. And we'll get some back, and we sold some January 11 calls, which is unfortunate because they're already in the money. We popped so much that now we're like in trouble on our January calls, and we'll be waiting for the long dated options to sell puts. That's unfortunate that it popped so fast, but that was the only adjustment we made. And let's see if they're in there. I think they should be. Yeah, you see, we already made those adjustments. Right? Because it was a double down. Wait a minute. We rolled our 2021 15 calls to 2021 10 calls. 2021 10 calls. Here they are. And we doubled down. So yeah, so massive turnaround here right when we put a lot of money to work in it. But 232,000 from 178 is what, like 54,000? I mean, it's just crazy. It's another 30% gainer. And we don't even touch this portfolio. We made one adjustment. That is crazy. But, you know, I mean, that's why we didn't make, I mean, look, we knew we were well set up. This is just way better than I thought. And again, now when you make this much money, I don't like it though. It makes me want to cash out. Because I don't think next month we're going to make that much money. It's just highly unlikely. Now, Money Talk, we can't change at all. So exactly these positions, which were $114,000, because we only do, and I'm on the show next Wednesday. I won't be doing, again, we won't be doing a webinar. I'll be on Money Talk in the afternoon. I think 4:30. I'll find out for sure. They want me on shortly after the Fed. So they're doing a special show where we're going to talk about the Fed and hopefully talk about the portfolio a little bit. So Money Talk went from, oh, it didn't do much at all. That's interesting. 114 to 123, only gained $10,000. But actually, though, it started out as a $50,000 portfolio, so that's still 20%. So it was 129%, and now it's 146%, 15%. So it gained 15% this portfolio. Let's see if we can figure out why. What went wrong here? I think mostly it's this TZA position completely melting down. You know, that's a hedge, and I would have, you know, we would have adjusted it, but we didn't because we can't. Who else is really underperforming? LB. No, just didn't really, these particular positions didn't get a really big pop. Now, of course, it's up 146%, so it's not a disaster, but it's interesting that it did that. Hemboka, we were down a bit. Yes, we're back up. Fantastic. So Hemboka's up 5.4%. We were down 10% at one point. I think we were down more than 10% at one point, 15. So it's popped back up. Oh, THC is a big help in the Hemboka portfolio. Then we got Molson Coors coming back a little bit. The MJ ETF is still the big loser. Macy's making a bit of a recovery, and IMAX, I have great hopes for IMAX coming into the fall, and we only need to get 22 cents. Well, we only need to get to, oh, we're already at a target for IMAX. Look at that, because the target was very low. Very nice. Do we have any more portfolios? Short-term portfolio. So far, fantastic. Wow, still holding on to 800%. That's great. So our hedges haven't been destroyed. Oh, CMG, that's why. CMG just made a ton of money for us. They came down nicely from last time. Control F, STP. CMG is a big short, also a big short in a hedge fund, so I bet our hedge fund is doing nicely too. We have the short September 800 calls, and we had, those don't count. So we have this spread, we have the short 800 calls. Oh, they had already come down though. They were only up, but they were only up 720 then. Now they are up. That's not that much of a thing. Oh, I see. We did some stuff with it though. Boy, did we make this position? It's confusion. When do we do all these changes? We cashed the spread. We did this. I think we made some adjustments, interim adjustments since then, because we ended up with this position instead. And but it's doing much better because this is, well, you got 13, 20, 25, 30, about $30,000 profit there. Whereas before, no, we were at 30 then too. I don't know. Oh, no. There's this part too. I see. Oh, I get it. That's what we cashed out one of the spreads and it made the whole thing look drastically different. We cashed out this spread that was deeply in the money and we rolled to the other spread. All right, that's confusing, but I can see what we did there. That was the only change I think we made there. Soybeans we got rid of because we gave up on them. And although that might come back actually. And otherwise no changes. So we're actually, I mean, you know, the nature of these hedges is we're in pretty good shape. And it's not being hurt that badly by what the market's doing so far, although it's, you know, and it's protecting the long-term portfolio. That's the main purpose of the short-term portfolio. Fortunately, though, we do take advantage of cool opportunities like CNG or something like that to make a little extra money, which offsets the losses that we have on our hedges. You know, we find other things to short sometimes. All right, let's see if we have any questions. Only one. Brian says, NYCB time to cover. Let's see. Gotta ask me these things in chat though, because if you ask me in the seminar, it's like I can't make a trade on it. All right, let's see. La-di-da. NYCB. Okay, so at some point we obviously bought back the original covers, the short calls. NYCB is now at $13. We bought the stock for $12 and we sold $12 puts. I don't know what we sold the calls for, but it doesn't really matter anymore. So the question is it time to cover? Because these kind of plays, we're really in it for the dividend. NYCB. Ow! Wow, that really did pop. Yeah, it's time to cover, you're right. So in other words, this is what we call an artificial buy right. All right, and buy right, W-R-I-T. We buy the stock and we write, I'm sorry, it's not an artificial, it's buy right. An artificial buy right is when we have a bull call spread instead of the stock. This is a proper buy right. We buy the stock, we write puts and calls against it. So in other words, we make our initial position, we sell puts at a price we're willing to double down at, and we sell calls at a price that we're willing to be called away at, and we're mainly in it for the dividend. But I don't know what the call prices were originally, but what they are now, NYCB. So these calls go out nice and long too, which makes me more inclined to sell them. 13. So we could sell the $12 calls for $1.65, or probably, I'm sure we can get $1.70. We can sell those for $1.70. Or we can sell the January 12 calls for $1.30. Let's say we sell those for $1.35. I think that's a tough one because we're selling them in the money. No, I want the extra 35 cents. So yeah, if we sell the January 21, the 2021 calls for 170. What does that do? Forget that we made money already on something else, but in other words, we've taken in 295 for the short puts. So we're willing to double down at 12. Now we're going to sell the $12 calls for 170. So what we've done is we've taken the net price of the stock, which we bought for we bought the stock for $12 and we sold puts, but we didn't sell all the puts. We sold for $295 divided by 2 is about 147. Well, it's exactly 1 point. Nope. 12 minus 1.475 is 525. Now, if we sell 20 calls, if we fully cover with the calls for $1.70, we reduce the cost by 170, obviously, so we'd be down to like $9 with a call away at 12. But we don't really have to do that. We can do a half cover here because we like Community Bank, and hopefully we can give her room to run. So if we sell half, we're effectively collecting 85 cents, so 0.85. And we're dropping our basis to 967, and we would get called half away at 12, and then we'd keep the rest, or we'd redo our position or whatever. It just gives us more flexibility, and we're not worried about New York Community Bank. We don't feel like we need the protection longer term. So I think I would do that. I think I'd sell 10 because I'm not eager to sell, but they can easily pop back down and go back up. They're very, they're very rangy, but you see how they trend? They go this nice uptrend is being maintained. So down, up, down, up. By the time they come back down, they're not going to go back down much below 11, maybe 1050. If they even go down that much, but so figure they'll come down to 1050 or whatever. We are happy to own more of them. This is not even a very big position. So in the long, it's 25. So in other words, in the long-term portfolio, $26,000 is a quarter of a position for us. We have $100,000 trading blocks. So a $26,000 position isn't a big deal. And we'd love to have a chance to double down when they're cheap. They're not cheap now. So the best we can do is sell put, sell call, lower our basis. Now notice we're going from 12 to, and again, we've already successfully bought back short call, so it's even lower than this. But our basis is 967. Probably our basis is more like 850. And then if we get called away at 12, it's a nice profit there. And meanwhile, we're collecting dividends, which are probably going to be in the notes. $6.80, 34 cents a share. So we're getting $1.50, not $1.50, 70, $1.40. So we're getting about $1.40 in dividends off of this stock, which works out to a nice amount. I mean, off of $10, actually off of $10 per share, it's a 14% dividend that we worked our way into on this stock. I mean, that's fantastic. Why would anyone put money in the bank? Why? Because they can't afford to play the options market. But other than that, I don't understand why people would have any money in the bank. We're doing this in the hedge fund too with all our extra cash. We're collecting like 5%, 10% a year on any cash sitting around instead of like having to do nothing. It's a huge benefit for the people who invest in it. AT&T, have you looked at Elliott's proposal on this? No, not heavily looked at it. I mean, I get the gist of it. They want to break up the company essentially into smaller bits. I think it's a mistake. I think they're right in the middle of consolidating and bringing the business together. So I think that I don't think now is really the time to break it up. It's not a disadvantage to us as shareholders. If they do, they'll unlock value. Although I would take advantage of I'd be out. I mean, if they do it and they break it up and I can sell off my bits for more than that, for like $40, I'll take the money. And we have AT&T. We always have AT&T because this is like the greatest stock. I'll miss it if it's gone. And AT&T is all, where is AT&T? Oh, it must be in the proper dividend section. The reason that some of these dividend payers are not in this section where we have our dividend stocks is because if we have any unevenness, it doesn't work. It reclassifies them. So these are called covered combinations, which is what our buy rights are. They're basically covered combinations. It works in this section only if it's here. As soon as I unbalance them, though, it flops down to the custom spreads. So in AT&T's case, though, it's a proper spread. We did the whole thing on 5.3. Now notice what we did here. We bought the stock for 30.60, 3060 minus 290 minus 375. So 23.95. So we dropped out. So in other words, we bought it for 30.60, and immediately by selling the $30 calls and $30 puts, and they can't possibly both be in the money. Only one can be in the money, so we have a $5-6 cushion on the spread. So we've knocked a considerable amount off the net price of the stock. We're down to $24 basically. So we've knocked 20% off the price of the stock the day we bought it. And the worst thing that can happen is we'd be forced to buy we'd be forced to buy 2,000 more shares for $30, for $60,000 more dollars. Now here we made a bigger commitment because it's AT&T. We weren't worried about it. We spent 77 minus 17 is 60, minus 25 is no, I'm sorry, take that back. We spent 60,000 minus 6 is 55, minus 75 is 40 something. So basically it's like a half an allocation block. So about 47.50 was spent here initially on the spread. And now these long calls have jumped up to $77,000. So this is 47,000, 30,000 profit here just on the stock if we can roll out the calls, but the calls are deeply in the money. So we probably can't roll out these calls without buying more stock or doing some other things, which you're probably not going to do. You know, we're mostly in it for the dividend. In AT&T's case, the dividends are, I don't know what the ordinary dividends are. See, the problem is that we don't book the dividends all the time. So that can't be, I don't think that was for one quarter. I think that was just going back a couple of quarters. You know, every once in a while we go through the dividends and then count up how many quarters we missed of booking them and make one booking. Where is that? What does AT&T actually pay as a dividend? So they pay $2 a year. So that's why it was $1. So we had 2 dividend payments in one there. Where was I? So we're collecting $2 a year in dividends on the stock, which is fantastic. 30. Well, what was a $30 stock? We paid. What did we pay? We paid $24, and we're collecting $2 a year in dividends. So that's, you know, getting around 8% dividends that we're collecting from AT&T. In addition to, if we do sell it at 30, if it ends up getting called away from us, we make another $7, which is basically 30% of the price. So we're gonna make 30%, and we bought this back in May, and we're gonna make $3 more in dividends. So we're gonna make $10 from 24, and 10 divided by 24 is 41.6% in 18 months. And all we did was promise to buy AT&T for $30, which is basically the low part of their channel. You know, if you look at AT&T over a long period of time. All right, 30, not the lowest, but 30 is a good low part of the channel. They go below that, but the whole market was terrible here, so you don't count that. And mostly, they don't go much below 29, 30 range. So when it got to 30, that's our buy point. We said, yeah, we'll take some of that. And now it's at 38, which is the high point. But we don't care. As long as it's 30, we're going to make our money. And again, these are, you know, it's a good time to look at it because now we're at the market top. These are nice conservative plays. And when you're in a bull market, they make fantastic returns. Better returns than anybody's making anywhere. You know, there aren't many hedge funds doing better than 20%. Our hedge fund's like at 40% right now. You know, there's not many funds that can perform this well, but we're not going crazy. We're not making big risks. The ones that you do see in that range that are up around our level of returns are ones that are generally taking very big risks and making very big bets that are specific, and they get lucky and they make the money. We're not doing that. We're doing these nice spread out, diversified risks, and we're just putting money into it day after day. You know, and when it goes down, when it dips, we're putting money in, and this is how it works, and this is how it cycles. So it does sometimes go down. We are a little more, you know, we're more volatile than a lot of funds because we're going to ride out these dips, and we're going to put more money in when we get a dip so that we reap the rewards down the line. And that's what we do in these portfolios. And this is what I'm trying to do. I want everybody to learn how to trade like a hedge fund manager, but not like a bad hedge fund manager. I want to teach you how to trade like a good hedge fund manager. Because frankly, I mean, the retirement funds and everything else is going to crap. And you're going to have to worry about your money and your kids' money and your grandchildren's money. And you're going to have to teach this to your children and grandchildren and family also. And then you're probably already worried about your parents' money if you still have parents. You know, my mom's 78. She's in great shape. she needs that money to last. You know, and the thing is, it doesn't get less. The Social Security check is ridiculous at this point. I know my grandmother, who died about 20 years ago, she lived off Social Security check. She had a Social Security check and one pension check from my grandfather. And yeah, my parents kicked in some money and helped her out once in a while, whatever. But she could live in an apartment on her Social Security check and go and get food and stuff and even went out once in a while. You know, and she lived in Florida. My grandfather died my grandfather died, I was little, it must have been about 1970. And my grandmother lived 30 years without him. And, but she got by on the pension and on the Social Security check because at that time, it actually was enough money. Now it's a joke. It's just become a ridiculously low amount of money that people cannot survive on. And, you know, so it's not, you know, so you got to make sure that money lasts for you as well, obviously. I mean, you know, it's hard to stop working in your 60s and then live another 30 years. That's like a huge portion of your life you live without any new income coming in. You have to know how to generate a reliable, safe stream of income, and all this gung-ho bullshit trading momentum stocks isn't going to get you there. But this is solid, consistent play with diversified blue chip positions. You know, and yes, some of our positions are maybe a little risky, but let me tell you something. If you go back 2 years when we started these portfolios, we don't start out with a lot of risky positions. We add them as we're doing well. So in other words, when the portfolio is up 50% in the first year, I'm willing to take a chance and add this and that I wouldn't have added otherwise. Now, what would I consider risky? Let's take a look. Frontier. Here's a good one. All right, Northern Dynasty. We never put that in the portfolio early on. We did start in April because we got off to a good start with the portfolio, made some money. And I said, you know what? I love these guys. They've gone lower. We started higher. Northern Dynasty has not done well. But now we ended up with a proper position. Why? Because each time I have to make a decision, we have a portfolio which is now up 200% in 2 years. So we have a portfolio, and every time I looked, I said, well, we got plenty of money. Let's put some more money into Northern Dynasty. CDE, we cashed out. So we're not going to talk about that. Apple, obviously, we always love them. Broadcom, Boeing, CH, what the hell is this? It's a hospital of some sort, right? Cardinal Health, CAH. Oh, I'm so good. All right, Cardinal Health. Let's see. Boeing, Boeing. Oh, sorry. Caterpillar, Chipotle, CPB. Oh, Campbell. CVS, Dan, DKS. That's the sports guys. eBay, Intel, MetLife, Sigma. You notice how these are blue chips. They're all blue. And basically, we're just saying if they get this cheap, then we're happy to buy them. That's all. If they get this cheap, we'll buy them. Now we still don't forget though. We put it in the call. We killed all these positions. All these short puts are gone now because we are expecting a market sell-off. So we don't want to get caught with a bunch of puts. Frontier been a disaster, but coming back a little bit now. The REITs, the REITs. We have some REITs, we have some banks, we have people dividend paying stocks, and we have about 3 or 4 more down here. That's just places to put the cash. We're not trying to make money on the dividend stocks. We just want a nice, good place to put our cash and get a check and get some interest. Apple, ALB, they make lithium. Alaska Airlines, we love. Bed Bath & Beyond. BHC is Bausch Healthcare. That's contact lenses and crap. That's good stuff. Citibank, Cheesecake, Celgene, Biotech was not risky now because they got bought out. It was maybe a little bit risky at the time. You still see, all right, now, CHK speculative. We think it's going to go up. We think it's too cheap. We keep putting more money in again. I wouldn't have done that. Notice how the date's in July. Wouldn't have done that right off the bat. You see ones in January, those are the ones we went for right away, January of last year. But the riskier ones you'll see tend to be added later. Chipotle we shorted because that was a different kind of move. And by the way, it's bullish. It looks bullish, but we actually we were playing it to sell the short-term calls. The main reason we got into Chipotle was to sell short-term calls, not to try to make bullish money off Chipotle. I'm sorry, that's incorrect. Originally, they were really cheap because Chipotle got so cheap that we decided to play them bullish. Then it turned into a play where they got too expensive, and we decided to start playing them bearish. Anyway, Caesar, Delta Airline, Disney. I mean, look, these are not risky stocks. And the ones that are, okay, here you go. No, GIS is not a risky stock. GNC, another one that we took later on. Oh, I'm sorry. No, we saw IC. We originally sold puts, and then we got into it because they got even cheaper. And this is just starting to make a comeback also. Barrick Gold, GoPro. I see GoPro is kind of speculative, and actually, that's not good. Goldman Sachs, Haynes. Haynes was a stock. Haynes was a runner-up for the trade of the year when we picked Limited Brands. Or actually, this became our trade of the year because at the time we picked the trade of the year, which was November, Limited Brands had already taken off, so we ended up picking Haynes for the trade of the year. And it's doing fine, so it's fine. IBM's our current trade of the year. IMAX, we always love. International Paper. Kraft Heinz has been a disaster, but I love them down here. Here's Limited Brands. We're still at a loss for these guys, but we'll come back on them. And this is a double dip, though. Our trade of the year worked out. It's just this is now, we're back in again for this year. Lockheed Martin is my stock of the, wait, was it stock of the century? I think it's stock of the decade for next decade, or is it stock of the century? I forget. Anyway, I like Lockheed Martin a lot for long term. Macy's, the marijuana ETF is risky. All right. And again, you see, they're not really, we didn't commit a lot of money. It's 26 minus 11 minus 16, 27. We committed $0. And so basically you say, well, we sold the puts and we agreed, but we said we buy in at 30. Not working out so far, but it wasn't a huge commitment of capital. Philip Morris, Mittal Steel, Micron ended up doing well after it did poorly at first. NLY is a REIT, NYCB we just talked about. Dave & Buster's is more of a speculative thing. Restoration Hardware I don't consider speculative. I think that's very solid. Tangier we just talked about. Skechers I don't think is speculative. SunPower I don't consider. It's a little momentum-y, but I don't consider it that. I think technically that's an industrial at this point, if I can tell. It's basically a chip company that makes chips for solar. STMP was speculative. That's Stamps.com. That one worked out nicely. STT is working out, but also not speculative. AT&T, Target, Tenet Healthcare, UCTT, a little speculative, and a small position. Walgreens Boots, I don't consider speculative, hasn't been doing well, but I think that's a great stock to hold. Whirlpool, certainly not speculative. They just got hammered by the trade, but it came back. And Wheaton Precious Metals is my stock of the year from a couple of years ago, and it's like the third time we played them and made money. So, I'm sorry to repeat it, but I want to hammer this home. These aren't risky positions. This isn't a risky portfolio, but it's up 233% in 2 years. Just doing these basic things that we're going over today. And again, the reason I want to start a new portfolio, aside from the fact that it takes me 2 days to do a review now of this portfolio, because we have 52 spreads. We have 5 covered calls. We no longer have the put, so it'll take a little less now. But we have 60 positions here. I have to do a half hour's worth of work basically on each position to just before I make a comment that says we'll keep it. I still have to do all the work just to end up not doing a trade. It doesn't mean I didn't have to look it over and check all the numbers, and read up on stuff and see if anything happened and changed and so on and so forth. Every month, and you have to do that with your positions every month. That's what you should be doing. But the point is that being up 200% in 2 years is ridiculous, and it would be a good time to cash in because it's very, very unlikely this kind of pace continues. And if it does continue, there's plenty of stocks we can still buy that are still cheap, and we can start from scratch and do it all over again. So I'm not scared of starting over. There's always going to be bargains to find. There's always going to be stocks that we can pick up. And also, it's important to learn how to build these portfolios because you're going to have to do it forever. I'm trying to teach you how to build these things and how to run them, not how to watch me build one. You know, it's like down the road, you need to pick your own positions. And by the way, in chat, I would really appreciate if people came to me with more positions. Albo picks stuff all the time. Other people pick stuff. But for most people, 90+% of the people in chat never say a word. You know, it's like most of the people who subscribe don't talk in chat, which I don't understand. It's like, you know, you must have something you're interested in. You must have a position. I mean, I know I can be mean sometimes, you know, like because I'm just in a mood, which I mean, look, you do this all day long. You're in a mood too. But I try not to be nasty about things, but I don't feel like it's like you're the dumb kid in class or anything. It's like, just, if you have a question, ask a question. If you see a stock you like, ask me and I'll take a look at it. But you know, it's like I can't watch every single stock on the market. If you hear something interesting and think a stock is good, tell me. I'll say it's either good or bad. And I'll try not to be mean about it if it's really bad. But anyway, but like I said, the main reason I say no to a stock is because I do think it's risky and it doesn't suit our portfolios. And the main reason I say yes to a stock is because I think it's a good, solid company that I don't mind riding out a dip, that if it goes down, I'll buy more. And that's what I can say about it. Every stock in this, and we purged, of course. There were other stocks that we purged over time. You know, and mostly because they were winners. Most of the things we purge are because they do very well, and we say, okay, we're done with that one. How to run? It's over. These were the ones that survived that gauntlet by virtue of not doing well pretty much for the first year and a half of having it. And in the summer, when we did a big purge at the beginning of the summer, these guys survived. So all these stocks were stocks that like I thought were just, you know, stupidly cheap. They're all value stocks. They're all good stocks. And they're all things that if they went lower, we were going to be willing to stick with them. What did we just do? Just last month, we stuck with them and we put more money into them. And again, like I said, I think we probably made an extra couple $100,000 because of those moves. You have to do that though. You have to have a system. You have to scale in. You have to have plenty of cash on the side to be able to ride out the dips and to be able to take advantage. Not just ride out the dip, not just survive a dip, but take advantage of a dip. You can't just survive. Okay, you can't just be on a raft in the ocean with waves crashing around you and your only plan is to survive the next wave. That's not how you should be investing. Okay, the way you should be investing is that you say, wow, that was a big wave, but now I'm going to take advantage of the next wave because I know what direction it's coming, and I'm going to put my sail this way, or I'm going to do something, turn the boat this way, and that way when the wave hits, it's going to push me in the way I want to go. And that's what your portfolio has got to do. It's got to push you the way you want to go. And if it's not going that way, you've got to take action and direct it in the way you want to go. And that's all we do every week. And you can go back on the webinars and you can go to these webinars for like the last 2 years. You can go back and read all the portfolio reviews we've done over the last 2 years, and you'll see how we grow each of these positions. And mostly we leave them alone though. But we leave them alone because we buy deep value. Again, I just went over the list. They're all good stocks. None of these stocks are not like speculative stocks. They're not stocks where you don't know if they're going to make money or not. You don't know if they're going to survive or not. You know, yeah, okay, maybe Macy's might not survive or whatever. But, you know, I mean, there aren't many that we take a chance on. Most of these stocks, we're not taking any kind of chance. They're blue chips. Big, giant companies that are very, very unlikely to go down. And to have, or to go down permanently so that they won't turn around. So even if there's a catastrophe, we will still be in play on this portfolio. And this portfolio, and that is not in any way, shape, or form sacrificing gains. We started this portfolio January 2018 with $500,000. And now we have $1.6 million. So we made 233%. We made 233% on that original $500,000. Nothing crazy. We're not gambling. We're not day trading. We're not buying speculative stocks. A few, but like you saw, a very small percentage. There's room for speculation, but only when you're way ahead and only when the money of the speculation isn't going to kill you. Look at Harmony. That was a disaster, $11,000 loss. I don't care about these 11,000. You know, I'm not don't care. It's in the scope of the portfolio with $1.1 million in gains. We lost $11,000 on Harmony. It was speculative, and we kept at it, and we kept putting more money into it, and it just went down and down and down. Now it's basically zero, and that's a loss. But it's an affordable loss. It's a very small percentage of our portfolio, which was miles ahead, which is why we didn't mind taking the risk. Because if it had worked out, it would have been great. It didn't work out. There's not too many like that. We stay away from those kind of trades generally. And that's it. That's the point I wanted to make this week. The big point I wanted to make this week is that, you know, it's stunning how fast these portfolios can turn around when things go well. But also keep in mind, like I said, the time before this, the review before this, we had lost $300,000. But what did we do when we lost $300,000? We did not cross our fingers and hope things got better. We strategically improved a large, probably about a third of our positions. We put more money into and improved them. And now that they turned around and now that we're back up and made a huge amount of money, now we're going to go back to cash, and we're going to cash things out, and we're going to take those profits off the table. And again, frankly, at this level of the S&P and all the indexes, I'm kind of inclined to maybe cash out the whole thing. I'm going to be vicious about cashing things out in the very least in this next review next week. So we'll talk about that then. But for now, we are done with this particular webinar, unless anybody has a last question. And nobody does, so I must have done an incredibly good or an incredibly bad job. I'll never know. But thanks everybody for coming. Like I said, next week we're not going to have a webinar. I'm going to be live on BNN Money Talk. And also we're going to be in portfolio review hell next week because I got to do all my portfolio reviews. And as you can see, just to read the positions takes 2 hours. Just to go over them verbally. It takes 2 hours. If I write them up, it takes double that or triple that, and then the research behind it is another 2 days worth on just the long-term portfolio. So that's my week next week. So if you think I'm in a bad mood, next week, you'll know why. All right, have a good day, everybody. Thanks for coming. I appreciate it.